Hello investors and future investors, welcome to the channel. For today's video, I will be showing you two stocks that I definitely think are undervalued. I'm going to show you how to use these two stocks in order to make consistent income by trading the stock and also by investing. Now, if you are new to options trading or you're trying to use options in order to make some additional income to help supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I will be giving you a step-by-step walkthrough of two stocks that I'm currently using in my portfolio right now in order to make consistent income. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. So the first stock we're going to feature today is going to be none other than Supermicro, and that ticker is going to be SMCI. Now, before I go ahead and get into this, I do realize that I do make these videos, but I don't have time to show my exit strategies because it's going to take a while and I have to exit these trades while the market gives me an opportunity. So what I've decided to do is that I've decided to go ahead and make shorter videos that I'm going to make exclusive only to the channel members. So you guys are going to know when, how, and why I exit a trade, just in case you guys want to follow what I'm doing. Now, let's go ahead and get started by going to the advanced feature right here. In order to open up the SMCI chart, we're going to go to the 1 year outlook to see how the chart is doing. Now, as you can see here, the current share price, which is 32.41 to your upper left right here, is currently trading below this blue line here, which is going to be your 200-day moving average. The two main indicators I use in order to trade stocks and invest is going to be the 200-day moving average and to the bottom here, your RSI. So I really like when the current share price is below the 200-day moving average or whenever the RSI is always 50 and below. Now, currently for SMCI, the RSI or the relative strength index is around 40. So any RSI from 50 going down towards the 30 tells you that that stock is going to oversold territory. So based on this chart, you could see SMCI is going to oversold territory. Now, the reason why I like the share price being below the 200-day moving average is because the 200-day moving average actually tells us, it gives us a good indication of where the stock price has been trading for the last 200 days or so. Now, because it has been trading around the 200-day moving average, this is just an estimate that the stock actually wants to trade around that price. So whenever the stock drops below that price, it's a decent indication, along with other indicators as well, that the share price can go back up to the 200-day moving average. Now, the current share price of SMCI, that is around $32. What we're going to do now, we're going to go ahead and go back to the 5-year outlook. We just did the 1 year outlook. Now, from the 5-year outlook, you could see this stock has a 200-day moving average of around the same thing. So this stock is trading at a valuation that's currently, if you were to look at it this way, it's been flat for 5 years. That's why I think this stock is extremely undervalued and it presents a massive, massive opportunity. So let's go ahead and we're going to go back to SMCI right now. Okay, so here we are on the key statistics, and what I want to bring to your attention is the 52-week high right here, which sits at 66.44. The current share price of 32 is about half the price of the 52-week high, not the all-time high, just the 52-week high. So if this share price were to go back to the 52-week high, you would get a gain of almost 100%. Now, that's if you have the stocks. If you do have the options, then wowee. So what we're going to do now, let's go ahead to trade SMCI options down here in order for us to go ahead and open up the options chain. Now, for those of you new to the channel, or if you are new to options trading, all this information down here in its entirety is representative of the option chain. What the option chain does is it gives us enough information in order for us to go ahead and make a very informed decision before getting into any options contract. Now, speaking of options contract, I want you guys to do yourself two favors before I go ahead and give you a complete walkthrough. Favor number one, always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for yours. Favor number two, always make sure to have an exit strategy before entering any options trade. That way, if the trade do decide to go tits up, then at least you know how to get out of the trade. And lastly, these videos are for education and entertainment purposes only, and they merely represent what I'm doing with my personal portfolio. So now that we have the options chain open for SMCI, here's what we're going to do. We're going to be going to sell, we're going to be going to call, and we're going to be choosing our expiration date. The expiration date I'll be using, I'm going to be going to the January 2nd right here, January 2nd, 2026, which gives me 40 days to expiration. The reason why I'm going to 40 days to expiration, I just mentioned, always make sure you have an exit strategy. Now, I will tell you what strategy I use to acquire the shares, but let me tell you the option strategy first off. So my exit strategy, whenever I do own shares in my portfolio, I always try to choose option expiration for 45 days out. And what I do, I always try to close these within 21 days of that expiration. That is just a strategy that has been proven by many people over the years. So I've kind of adopted that strategy. So we're going to go with sell, we're going to go to call, and we're going to go with the expiration date of 40 days out. Now I'm going to go ahead, I'm going to choose my strike price. And that strike price I'm going to choose above the current share price of 32.41. So let's go up, and we're going to be choosing a strike price. Now the strike price I will be going with is going to be the $43 strike price right here for numerous reasons. One of the first reasons I'm going to use the $43 strike price here is going to be based on the chance of profit. The chance of profit here is going to be 89.36%, which is roughly 90% chance. So that tells me I have a 90% chance of this trade going in my favor. It also tells me I have a 10% chance of this trade going against me. So this definitely works for my portfolio. So I'm going to go ahead and select that strike price. Now, this is an income generating option strategy known as the covered call option strategy. Whenever I go ahead and I execute this trade, I will be receiving money. The money I'm going to be receiving is going to be 0.54 in options world. When you translate that into the real world, that's going to be $54. And that's simply because each option contract does contain 100 shares. So you're going to multiply your 0.54 right here by 100 shares, and that should give you $54. Now, I did mention that I have several reasons for choosing the $43 strike price, and that's just one of them. The other reason I'm going to choose the $43 strike price is because of the way I acquired these shares. The way I acquired these shares is that I went ahead and I bought 100 shares outright. So if at the time you're watching this video and SMCI, let's say, is trading at this price, let's say $32, then you went ahead and you bought 100 shares, that's going to cost you $3,200. So by using the $43 strike price, it puts a great distance between the price I paid for it of $32 per share and the strike price I choose of $43 per share. So remember, I did mention there's a 10% chance that this trade can go against me. So if this trade does go against me, then I'm still going to benefit. Here's how I'm going to benefit. If at expiration date, this share price happens to go past this $43 strike price right here, then I would have lost my 100 shares that I use as collateral. Because this is a covered call option strategy, there's two ways in which you could actually do the covered call. Right now, I'm going to demonstrate the first way, which I did, which was buy 100 shares, and I'm going to show you the second way in just a second. So I bought at $3,200, but now I lost my 100 shares, but the price I lost it at is going to be $43 per share, which is going to give me $4,300. So I lost my 100 shares. However, in my portfolio, I'm going to receive $4,300. So although I lost my shares, I made some money. Here's how much money I made. Because I went ahead and bought the shares outright, then I own 100 shares. So I'm going to get the difference between the price I lost my shares, which is $43, the price I paid for the shares, which is $32, which is going to represent $11. Once again, we are dealing with options contract. I'm going to multiply that $11 by the 100 shares, and that's going to give me $1,100. So that is another reason why I went ahead and choose this strike price so high up. So if I do lose the shares, I could also benefit from what's known as share price appreciation, or how I like to call on this channel, investment gains. So I will be making $1,100 plus $54 right here, which is not a bad investment. Now, that's what I'm doing with my current portfolio right now. If you guys do not able to have a portfolio that can manage to buy the shares outright of $32 per share, then you could go ahead and use this option strategy. So let's go ahead now. We're going to change the parameters. Let's go to buy. We're going to go to call, and then we're going to go ahead and choose our strike date. The strike date I'll be going with is going to be, let's go for January 15th, 2027, which gives us 418 days to expiration. Now, this new option strategy is going to be known as a leaps option strategy. A leaps option strategy simply means that you're going to be buying a call for more than 365 days or further out than a year. What this does is that instead of you having to buy 100 shares outright, this allows you to control 100 shares for a lot less money, aka leverage. So the strike price I will be using, I'm going to go ahead below the share price, and I'll be using the $30 strike price right here. And because this is a buy option strategy, I'm going to have to pay $1,190. Remember, the first option strategy I showed you, which I went ahead and bought 100 shares, I paid $3,200 in order to own 100 shares. By utilizing this option strategy, which can be used if you have a small account, if you don't have $3,200, then you're now able to control 100 shares for only $1,200. When you are able to control 100 shares of SMCI for only $1,200, now you could go ahead and sell covered calls. So this option strategy that allows you to control 100 shares is going to be known as the leaps option. Now that you have the leaps option, I'm going to show you how to go ahead and sell covered calls. So let's go ahead, change the parameters once again. We're going to be going to sell, we're going to be going to call, and let's go ahead and change our strike date. Before we change the strike date, I want to bring one more thing to your attention, and that's going to be your break even. Your break even right here is 41.53. Let's just say 41.50. So we're going to be selling covered calls. We're going to go sell, call, and now we're going to be choosing the strike date. As per the first option strategy, I owned 100 shares, but this one, I'm going to be using a leaps option. So I'm only going to be going 30 days out. I do not need to be going 45 days out because this is a leaps option. It's a different strategy from just owning the shares outright. Now I'm going to go ahead and select my strike price. Now remember, by doing this option strategy, I'm going to be using the leaps option for the collateral. So I'm going to have to go above the 41.50 price, which you saw is the break even. If you choose a strike price anywhere above that, if the trade do decide to go against you, then you're not going to be at a loss. So once again, I'm going to be going right now for the $43 strike price right here, which hits every single one of our criteria. Once again, the $43 strike price here, it hits my criteria for me doing leaps option. It hits my criteria of a chance of profit of 80% or higher. It also hits my criteria for receiving decent income. So the income I'm going to be receiving is going to be 0.31 or $31. If you divide your $31 by the price you paid in order to acquire leaps option, which is going to be $1,200, you're going to see that's a really, really nice and decent return. That return is going to be 2.6%, which again suits my portfolio criteria. Now, the reason I did not do this calculation for the other option strategy is because I own the shares outright. My main goal is to win with capital gains. In this case, my main goal is to make sure I make some decent income that lands in line with my portfolio while trying to keep my collateral. And my collateral in this case, remember, is the leaps option. So there you have it. If you are trading with a small account portfolio, consider this option strategy. Now, whenever you decide to sell a covered call by using a leaps option as your collateral, that creates a whole new option strategy. That new option strategy is going to be known as a PMCC, or the poor man's covered call. So if you guys wanted to do any research on that, just simply go to the channel, type in leaps or PMCC, and you're going to get detailed videos of how I do this. This is my bread and butter option in my portfolio. Now, if you guys are getting any value from this video right now, go ahead, like the video, subscribe to the channel. Now let's go ahead and get into the second undervalued gem that I think is going to do wonders, especially if you're trading with a small account portfolio. And that stock ticker is going to be HIMS, or Hims and Hers Health. So let's go ahead and get into that one. Okay, so here we are on Hims and Her Health, and what we're going to be doing, we're going to be going to the advanced feature once again. So we're going to go to the 1 year outlook here. And then once again, the exact same identical setup. The current share price of 34.98 to the top left here is currently trading once again below your blue line here, which is your 200-day moving average. Your 200-day moving average, or the price the stock was trading at for the last 6 months or 200 days, is around $47. And if you go down and you check out your RSI is around 43. Again, it's below that 50 mid RSI point. So let's go ahead and get back into HIMS. And I want to bring one more thing to your attention to show you why I think this stock is actually undervalued. Here we are on the key statistics once again, and what I want to bring to your attention is the 52-week high, like I did for the previous stock. The 52-week high is at $72, and currently the share price is around $34.98 or $35. Once again, if this share price were to go back up to the 52-week high, then you would be receiving upwards of 100% gain. Hence, that's why I think this stock too is currently undervalued. Now, let's go ahead and get into the options. Let's go to trade HIMS down to the bottom here in order for us to go ahead and open up the option chain. So before I go ahead and get into these option strategies and give you a full detail, I want to let you guys know that if you guys are trading with a small account or you are new to options trading, what I'd highly advise you guys to do is go ahead and open up a Moomoo account. With that Moomoo account, you guys could go ahead and deposit upwards of $100 and you will be able to use all of Moomoo's free resources. Now, here's one of the best part of investing with Moomoo. Moomoo will allow you to share fractional shares in order to trade. Now, if you are trading with a small account and you can't afford to buy like 500 shares of Meta, then by depositing $100 in Moomoo, you could probably buy only $5 worth of Meta and keep doing that consistently in order for it to go ahead and grow your portfolio. So if you guys want to go ahead and support the channel, please use the link in my description below. Now let's go ahead and get back into these option strategies. So with HIMS, we're going to go over to sell. We're going to go over to call and we're going to choose the expiration date. Once again, we're going to be going to the 45 days expiration date, and that's going to be January 2nd, 2026. I'm going to go ahead, I'm going to choose my strike price above my current share price, and I'm going to be going with So I will be going with the $48 strike price right here. And once again, you could see my chance of profit is extremely high once again, and that's going to be 91%. Because it's an income generating option strategy, I'm going to be paid, and I'm going to be paid 0.54 or $54, which is quite similar to the first stock. So by doing this option strategy, once again, my exit strategy, remember, always have an exit strategy. My exit strategy is to go ahead and close off this trade within 21 days of being in this trade. Once I do that, this gives you one of the highest chances of being profitable when you're doing this option strategy. Now, by doing this option strategy, which is going to be the covered call, when I go ahead and do this, I'm going to receive money right away. The money I'm going to be receiving right away is going to be a fraction of how I acquired the shares. So once again, for HIMS, I bought 100 shares outright because I think the share price is currently really, really good. I went ahead, I bought SMCI outright. I'm going to show you how to control 100 shares once again with HIMS if you don't have a portfolio that can afford 100 shares outright. So the $48 strike price, 91% chance of profit, and $54 consistent to make income. You're going to be getting around $54 plus minus a few based on what the market is giving you, but that's just going to be income you're going to be making consistently every 21 days. So the other reason for my $48 strike price, once again, I want to distance myself from the current share price. So the difference between the strike price I chose and the current share price is going to give me a $13 difference. Now, remember, that is intentional. I do really go extremely high up because I want to protect my 100 shares. And if I do go ahead and lose my 100 shares, I want to make some serious capital gains or investment gains. So if I am assigned on this trade, or if I lose this trade, then I'm going to be losing my 100 shares that I bought at $35 per share. I will be losing those 100 shares at $48 per share, which is going to now give me $4,800 in my portfolio. The gains on that is going to be $1,300 plus my $54 that I received right here. Now, for those of you guys trading with a small account and you can't afford this, maybe you want to do this option strategy. Let's go ahead to buy. We're going to go to head to call, and now we're going to be changing our strike date once again. We're going to be going to, let's use the same strike date, January 15, 2027, which gives us 418 days to expiration. Now, this once again is going to be a LEAPS option strategy. LEAPS stands for Long-Term Equity Anticipation Securities. It is a mouthful, hence we just say LEAPS option. Now, once again, I will be going with the $30 strike price here because after doing my own due diligence, I do my research. I think this gives me the best risk to reward. As this is a buy option strategy, I'm going to have to pay, and the amount I'm going to have to pay is going to be 15.7. Now, 15.7 is going to be around half the price, well, less than half the price of if you had to buy 100 shares outright. So by using the LEAPS option, you're now able to control 100 shares of HIMS for a lot less, about half the price of if you had to buy it outright. Now, If I were to go ahead and do a leaps option on HIMS right now, I would not be doing the PMCC with HIMS. I would just have this leaps in my portfolio and I'll wait until the share price appreciates. The reason I would not be doing the PMCC with this stock is because this stock moves extremely quickly. So I would not risk making small money in the short term and give up the big money in the long term. Hopefully you guys understand that. So there you have it, investors and future investors. I think SMCI, Supermicro, and also HIMS and Hers Health, HIMS, are two of the most undervalued stocks that's going to give you real quick returns in the short term. And if you're not assigned, then you will be making lots of money in the long term. Now, for those of you that made it to the end of the video, if you guys have any questions about HIMS and Hers stock or Supermicro stock, let me know in the description below. Remember, I'm not going to have enough time to make a video about my exit strategies, but I will be making shorter videos of when, how, and why I exit my options or my shares position, and that's going to be exclusive to only channel members. So if you haven't already, go ahead and sign up for the channel member. It's really affordable right now. That price will go up in January. Now, thanks for watching. And lastly, if you guys know of anyone out there that can benefit from these videos, then the right thing to do is to go ahead and share this video with them. Together, let's help as many people as we possibly can start making income from options trading. Now, until the next video, keep pushing your investments.